afternoon, everybody. Welcome. Excited to have you join us this Wednesday afternoon, January 14th, 2026. Beautiful day. Excited to have you guys. Thanks for coming along here. And we're going to talk some pretty in-depth topics, some pretty unique topics. We'll try to keep things on a higher level, but we can certainly drill into a lot of things today. We will be talking about interest rates, interest rate conversation, specifically on how interest rates affect the lump sum pensions. We're going to spend some time talking about the Pension Protection Act of 2007. So for those scholars that don't remember everything of that, maybe there's been some other news that's happened in the last 19 years. We're going to go over a couple of things there, and then we'll talk more specifically about the numbers that we're seeing with those pensions today, and really how do we make really big life decisions off of what we're seeing in some of these interest rates and how it's going to impact you. So I'm Brian Windsor. I am a certified financial planner. I am with Bogart Wealth. My title, I'm a vice president financial advisor. I mean, really simple way of putting it is I give life advice to our clients and about helping them steer in a better direction. Life is complicated these days, not just from everything that you see on the news, but also when it comes to your family's finances. So hopefully today's conversation can really help a niche part of your financial plan and understanding a little bit more about really what goes into some of this and the calculations. But then also, I think the most important thing is what's the impact? What's the impact of this information into your financial plan, which that's what we're here to help do for you. I got to get used to this. We used to have, maybe it's not the mouse, but I want to go underneath the microphone and move things around. This is a really cool setup that we have here, doing these podcasts. So these seminars, this is where we do the podcast too. Just really, really nice studio setup. So if you've been following along with us before, it's continuously getting better. That's what's really exciting about Bogart Wealth and working with us. The firm launched officially the LLC in 2016. We currently have 3 office locations. Majority of my clients are all over the country. I think what's most important to me and the firm is that about 1,400 households look to us as their primary financial advisor to ask just the really difficult questions in life, but also like the really simple questions too. So we're here to partner with our clients and their families to help them navigate through a lot of life's complicated decisions. All right, so Bogart Wealth helps with the financial planning, the investment management, and then really the tax estimations, and also tax planning and tax filing. So there's a lot of bigger lifts that we as a firm do. And so if you haven't worked with us before and this is your first time joining us today, welcome. Really excited to have you aboard, share some expertise on really this really in-depth topic. But know that this is not just one area that we help support, a much broader way that we can help look at things holistically. And really, how does this discount rate or how does this pension plan fit into my overall financial plan? It's a really big question. There's a lot of other people in your lives, I'm assuming, that are going to be in part of that decision making. So let us partner with you to kind of show you the ins and outs and how that's going to work. As we're getting started, we're going to jump into some of the topics today. You might have questions, right? I know I certainly did as I was coming into this. I've been with Bogart Wealth for about 4 years now, about 19 years in the industry. But there's a lot of unique natures to specifically the ExxonMobil pension plan. That's what we're really going to be focusing on today. You may have another type of pension plan that might work this way. It might be a little bit different. So hopefully that if you're here and you don't have the ExxonMobil pension plan and you're still looking to get some information, great. Glad you're joining us. Hopefully some information here is going to be relevant to you. But this is mainly for focusing on the ExxonMobil pension plan. So guys, I'm going to have the Q&A up as well. So if you have any questions, pop them in. I'll see them on this massive TV in front of me. So I should be able to get to some of those questions throughout our discussion today. Okay, feeling good? We're good? Okay, let's go. Okay, so let's first talk about the different types of discount rates. You'll see them. Sometimes you're saying, okay, which one is which? The general rule is that for most individuals, they're focusing on the plans that have the benefit commencement dates. Those discount rates are for those individuals that have started before the Pension Protection Act of 2006. Those individuals are grandfathered into a older discount rate that was being done. The majority of clients that I support and are supporting on they're either still currently making that transition. The majority of them are going to be on the discount rate, not the grandfathered rate. That grandfather rate is only available. I think the youngest you can be right now is the age of 68 years of age. So there's probably few and far between. I wouldn't be surprised if we don't have anybody on the seminar that actually has that. I haven't seen them in quite some time. So the general rule for the discount rate is we're focusing on the benefit commencement date. So your benefit commencement date, the date that you are actually taking the benefits, is always going to be on the first day of the month. Okay, so for example, if you want to get the second quarter discount rates, so I'm thinking second quarter is what? April, May, and June. My benefit commencement date has to be June 1st, absolute latest. Because if my benefit commencement date, let's say it's like June 2nd or June 3rd, well, then that's pushing me into a benefit commencement date July 1st. So that could have an impact, right? Because then you're looking at the third quarter rates. Does that mean anything? Let's find out. We're going to talk a little bit about the ins and outs of how these pensions can change. We're going to take a look at how things are just changing right now, actively, for some of the results that we're seeing now. I mentioned the Pension Protection Act. That was a big change in the industry that happened in 2006. When it comes to the pension specifically, the biggest items that changed were that they defined the discount rates that were to be used and defined the actual tables that can be used. So what that meant is at that point, they changed the underlying ways of calculating what these discount rates that are to be used for pensions. Before, they were just based off of treasury rates, risk-free rates. Doesn't get safer, and generally doesn't get lower. Why does that matter? Well, now that they've switched to corporate interest rates, there usually is a premium, meaning there's a difference in rates slightly higher on the corporate end relative to the treasuries. So what does that mean? Why is that a difference maker? As we'll find out, the higher discount rates are, the lower the lump sum value of that pension is going to be. Now, does that actually change anything if I take the annuity, the actual pension? None of that matters. None of that matters. That pension is going to be exactly what they were promised. But if your financial plan says discount rate, taking the lump sum is what I'm considering, that was a change. We follow the rates. This is what you're going to see in a few minutes. Other big things that changed, limits the company's offering a lump sum pension. If the pension itself is not more than 80% funded, then they may not be able to offer a lump sum. So if you have a pension with a plan and it's not funded up to 80%, you've seen the letters, and typically at that point you can only do the annuity option. In case of ExxonMobil, this has never happened, so it's not something we're too concerned about. And then there's some other changes on the qualified defined contribution sides that really helped on the other ends of the financial planning spectrum, such as after-tax balances roll to a Roth. That's awesome. That actually really impacts the Voya plan too. And thinking about all those other fun things like NUA versus Roth, just a new fun other things that we can do to help support you guys. We're not here to talk about that today though. All right, so let's talk about those couple important things and more in depth about the pension rules of the Pension Protection Act. So basically, in a nutshell, if you are under the age of 50 or had 10 years or less with a pension, starting in December 31st, 2007, you are now part of the new Pension Protection Act. So you wouldn't be able to be grandfathered in like some of those, like I mentioned previously. Well, that's why most people on here are going to be under these rules. So what did they define? And this is still the rule, where they are now using 3 segmented rates. So 3 separate rates to determine what is the discount rate, which is then used to calculate the lump sum value of your pension. They switched over to corporate bonds. They have higher yields than government bonds. Higher yields are bad. I love that. That's just cut to the chase. Higher yields are bad. We don't want them. The higher those yields go, the lower the pension becomes. They've changed the mortality tables that they have to use. ExxonMobil is still using the 2018 mortality table. So that's up for renewal in 2028. Longer life is good. For most people, I think, right? Longer life is good life. And so that affects people born after 1957 or hired after 1997, as we talked. Meaning because you'd have to have 10 years work experience. This is a cool chart. This is showing us how Bogart Wealth has been tracking the ExxonMobil discount rates over the last decade, and looking at how these segmented rates have changed. So we mentioned, right, hey, there's 3 separate rates that they use. Let's define what they are, and we can kind of see which ones are moving a little bit more rapidly than others. So there's 3 different types of rates that they're using to calculate the lump sum. The green line is segment one. This is shorter term bonds, anything from 0 to 5 years. You can see how those shorter term bonds, because they're not in long, they don't extend in duration very long, they usually offer shorter rates. But also you can see from the visual perspective, it looks to me that they are subject to a lot more volatility. There's a lot more ups and downs here in the shorter term end than the longer term end. Kind of makes sense. And then you have segment 2, which is sort of like the middle term, anywhere from like 6 to 20 year bonds. And then in the orange, which is the longer term bonds. I hit the mic. Is that what you saw? Oh, this is nice. If I hit this, it doesn't do anything. Bogart Wealth. This is a good setup here. Visually, what you can really see and how this has been operating over the last few years, post-COVID 2020, you can see some of those rates dropping pretty fast from where they were at their highs of 2018, 2019. If you've been with ExxonMobil the last decade, you've obviously have known people that have went through this, took maybe saw the lump sum as being very attractive in those earlier parts of 2020, 21, 2022. And since then, as inflation has really driven up in post 2021 and 2022, that's really lifted up those interest rates. And we're still feeling that today. Anyone that's been out there looking for a mortgage versus what it was 5 years ago, big difference on interest rates, both on the shorter and longer term end, very different time period. But you can sort of see right now there, within the last little bit, they are kind of lightening up a little bit. And so let's talk a little bit about how they've lightened up a little bit over the years. And let's talk about exactly how they're using these segmented rates, those shorter terms, those medium terms, those longer term rates. How are they actually using those rates to determine what the values are? There's a lot. Look at this. It's a very busy chart here. We calculate this daily. This is what we do. We're the dorks in the room that like the numbers to calculate things, but it allows us to give you really good information. The highlight of all of this is if you look at each quarter, because each quarter is defining what that rate is, right? What is the discount rate for that first quarter, or what's the discount rate for the fourth quarter of last year? So let's look at that actually. So if you can look at the segmented rate for the fourth quarter 2025 in the top left-hand corner, the first thing that jumps out to me is you see that April is grayed out. Well, why is April grayed out? Because in fact, only the last 2 months in each quarter are used to determine the discount rates. So for instance, the May 2025 and the June 2025 rates are the only two months that were calculated that whole quarter. April is kind of a wash month, just as July is a wash month and so is October. It is kind of meaningless for actual determining, but it certainly tells us the course. It tells us where those numbers are shifting from. So we certainly pay attention to it, but we know it doesn't impact the numbers. So you can see how, in May and June, those numbers are calculated for each of those segments. And again, one thing to mention is that it's the rates in the second quarter that determine the fourth quarter rates. We're always 2 months ahead or 2 quarters behind. So right now we are in the first quarter of 2026. It's January 14th. 2026. And so the rates back in August and September are what is dominating the decisions that we're making today. Now we can see November and December rates. Now, some of them are not completely finalized yet. We'll get that from Treasury actually pretty soon. I think this week or next week, Treasury is going to be releasing those rates. I'm not sure if it's going to be delayed because of the shutdowns and the work, but we are expecting to see the official rates, but you can see that we projected on a daily rate. And then it's an average on the month, and then that's the number you have for the month for each segmented rate. So this helps us determine, okay, now that we know how these rates are currently and what they're projected to be, it helps us determine our clients, what is that individual single rate? Creating a single rate equivalent is just simple and more easy to compare and seeing how rates are shifting. And this is live up into, this doesn't include, yes, this fourth quarter of 2025. So that's an include up to that. Okay. So you can see all of the dates that we have going back till 2021. Busy chart here. But on the right-hand side, you see the single rate equivalents. Depending upon the age you retire, it can go into the calculations and factors on what those rates are. But let's just look at a retiree age 60. That means that you're fully vested in your ExxonMobil pension. You can see that over the last little bit, as we talked about interest rates rising, you really get a sense that since 2022, we've seen rates in the single rate equivalent around a 5 to 5.25 rate, peaking really just this past summer. The second quarter 2025 rates, which applied to anyone that was retiring in the fourth quarter of last year, it hit a peak of 5.54, and since then we're seeing it trickle down a little bit. What does all that mean? We're going to find out in a second, because we're actually going to get into some real life results on how do these rates move, and as they move, how does this impact the lump sum amount versus the annuity? These are big decisions that you have to make. We're here to partner with you. We're here to work within the financial plans, understand where does this money fit into your specific situation for you, your spouse, your family members. These are all really big decisions, and the timing of this is critical. Another chart where instead of all three segmented rates, this is how you can just see going back for the last 40 years on how these single rates have been calculated. The all-time lows were back in 2020 post-COVID due to that environment. Within 2020, and then since then, inflation's kicked up and those have gone up. Quick question, why is the rate different between 55 and 60? Mainly because of longevity and time frames on when the pension's being taken. So let's talk a little bit about, we'll see some examples on difference on longevity here, and how we get into some specific examples, how these lump sums can change. All right, so this is a sort of it would have been a real life example for somebody that would have a present value annuity of $74,000 a year. So this person is going to retire now, within the next, 2 months or so. They're retiring at 60. IRS life expectancy says that they're going to live till 84. I mentioned it earlier, but I'll say it again. The annuity factor never changes for this individual. No matter what happens to the discount rate, the benefits department have said, based off of your work tenure and your salary, you're entitled to a $74,247 a year pension. Now, based off of the discount rates that you're seeing here, that present value lump sum for that individual is $1 million. We backed into that. That just didn't happen by happenstance. There's some smart people that can calculate all this stuff. But that gives you an idea of saying, okay, this individual with the current interest rates, you see the three different segments at the top, they would get a pension of $74,000 a year. Or if they took the lump sum, they would have a rollover that they could do for about $1 million. Now, benefits of doing the rollover versus taking the lump sum, separate conversation. Contact Bogart Wealth if you want to go through that more. We are talking more specifically about just the valuation on the lump sum. I'm not here to steer you in one direction or the other because everyone's situation is going to be entirely different. All right. Good point. So the higher interest rates equal the larger discount. So when you're actually applying those segmented rates, what you'll see is that that first segment, age 60 to 64, that is applying the segment 1 interest rates, 4.13. Then you'll see the years 6 through 20, ages 65 through 79, it's that discount rate, 5.20%. And then the longer ones, 5.98%. And so this, to answer your question about longevity, we're going to get that in a second. So really what you can see is what moves the needle the most here. What moves the needle the most here for this specific individual is that segment 2, 6 through 20. So I get questions all the time. Brian, I'm not following this as much as you guys. By the way, we have an email we can send you up for. If you're new, get on our mailing list. We send monthly updates on what these rates are. But casual observer, if you're kind of just wondering for the sport of it, what's happening to the discount rate, follow the 10-year Treasury. Follow the 10-year U.S. Treasury. It just gives you an idea of where those rates are moving. Now, corporates are going to move a little bit differently, but for the most part, they kind of work in tandem. But I would be following that 10-year Treasury just to kind of get a sense of what's happening if you're curious. Okay, so let's talk about an individual here that would have less work experience. So an individual that would have less work experience, or I should say not fully vested in their pension, because if you remember with ExxonMobil, you get your full pension at the age of 60. If you take it sooner than that, you can do so as early as age 55, but every year you take it early, they give you a 5% haircut. Now you might be looking at me and saying, Brian, you can't get any more haircuts. That's true, but we're talking about a pension here, not my hair. But so here you would have a 75% pension taken at the age of 55 because they would have a 5% discount. So 59, 5% less, 58, 5% less, all the way down. So now they get 75% of that annuity of that 74,000 we looked at. So now their annuity is $55,000. Okay, so now how do we fund that annuity, right? Because we took it early. How do we fund that annuity? Here's where we go through those actuarial tables again into those segmented rates. Here's where you can then start seeing, because they have longer longevity, those longer term rates are going to be more prevalent. Remember, those are years 21 plus. So there's a difference in longevity factors between those that are retiring at 60 versus 55. We have to take into consideration that longevity factor. So we are taking those longer term rates more into consideration, and those rates are typically going to be higher. So because of that, that single rate equivalent is then always going to be higher between those are retiring at 55 and at 60. So that's to answer your question there. If you have any additional follow-ups, anonymous attendee, please let me know. All right. So yeah, this is where we look at how the internal rate of return is calculated. I mean, this is what the back office team is doing. Those guys and girls are super intelligent, smart, and how they calculate this, and how we can put it into use in the financial plan. So, how do changes in the interest rate change my lump sum? Because yeah, Brian, you're looking at rates right now for the first quarter, but we're just starting a brand new year. I mean, there's a lot of things that can happen. Feels like there's a lot that's already happened in 2026, but let's get buckled up because we still got 11 and a half more months to go. So we'll probably see a lot more news coming down the pipeline, and a lot of things could happen with interest rates. That's a big factor right now. Okay, so those that have a lump sum of $1 million, our rule of thumb is if you see a 1% change in the interest rate. Just think about that being a 10% change in your pension lump sum. So if rates go down by 1%, then in this case, look at the bottom right-hand corner, then the expectation is that your lump sum should now be $101,000. So a 10% change, 10.4. That's a good rule of thumb, though, is about 10%. So as we've seen modest changes and gradual changes, we just saw about a 25 basis point basis point change in those discount rates since the high over the summer. So you can see that's been about, in this person's case, so it would have been about a $25,000 change. Modest changes don't move the needle for a lot of retirees. Modest changes do not change the needle as far as wanting to make brash and rush decisions to retire. Those really brash, quick changes to interest rates, we do then see a lot more activity. But the thing is you need to know ahead of time if these things happen, what your action should be, why it's critical to talk to us now before you have to make a decision in a very, very short manner, which can be a life-changing decision. So partner with us now. We'll work with you, providing the insights of not only, when to do this, but really how do these monies fit into your overall financial plan, your investment strategy, and your tax strategy. We'll see how it's just changed right now. Yeah, good example. So if we have the projections that we have now, because we have the fourth quarter rates, and so what if you're deciding you're on the fence? Well, I'm going to go now, or I could still work I could work another few weeks. Well, if you do, and you decide you want to hold off till we're having a benefit commencement date on April 1st, so that would be any retirement post any retirement starting in April. You would basically then see, because those rates have come down a little bit, that segment 1, segment 2 has gone down. Now segment 3 has gone up, but we just saw that it's smaller, a smaller change. Again, that's segment 2. Those 6 to 20 year numbers are what's really, really important. So that change, that slight change in just that little bit, yields $5,000 more. Again, modest changes don't really lead to fast results. Big changes do. But again, if you're on the fence, this is really good knowledge to have as far as one way or the other. Do you even take it right away? Maybe you don't. You don't actually have to take it right away. Even if it's your last day of work, or you're retiring, you don't have to start making decisions on the pension right away. Now, if you got like a supplemental pension plan, that is going to pay out. That's always going to pay out the month after your benefit commencement date. That's just it. That's just how it's going to be. But you don't actually have to do anything with the pension right away. So there could be some benefits. Maybe I'm just going to delay it and not get that 5% haircut. Or maybe you're really, really, really bullish on interest rates to fall, and you're just going to wait. But there's a lot of risks in doing that. I generally don't recommend doing that strategy, but that's something for us to talk about. But that could be a reason to consider the delay. What's your timeline map? Generally speaking, if you are in the camp of considering retirement from a paperwork perspective, you generally want to get that started about 4 months. in advance or just started kind of getting that process worked on, you don't need to wait 4 months. I actually had a client in 2022 that we made a decision, I think, a week, and they retired May 31st, so they could get the June 1st lump sum. It can be very quick. Generally speaking, you want to make it a little bit longer, but you don't necessarily have to wait or wait 4 months before you kind of get things in motion. You can be a lot quicker if you need to. If you have this chart for the seminar, this one I like better. Just kind of gives me more of like a checklist on what I should be doing when it comes time to be, thinking about how to execute my executing my pension as far as like rollovers and things like that go. I won't read it line by line, but if you want a checklist, we have these. Let us know. We're happy to send it to you. Really helpful for specifically with the partnership we have with ExxonMobil as far as everything that needs to do with the benefits portal that everyone seems to love these days, and getting everything in place. That's good. What do you do now? Have a plan. If you haven't updated your financial plan in over a year, a lot's changed. There's a new tax bill that's out there. There's some changes, right? So if you haven't done any sort of long-term planning in the not too recently, it's a really good time to check in. And so you can understand, really what your situation is, what your plan is, and that's where we're here to partner with you. One of the big things too, a quick plug about us, is that we work a lot with ExxonMobil retirees well in advance of retirement. That's where our partnership has gotten so strong, where a lot of times I hear from clients, well, like everything's tied up. I don't have anything that I can really offer you guys right now from an investment management perspective. But let me tell you, that's our job as fiduciaries, is to meet our clients wherever they are. And so if you're getting to that point where you're starting to think about retirement into a serious fashion, that's when you call us. Generally, that's about 5 years out to start putting the plans in place. We do not charge to help provide financial planning, right? So we believe and have put out a really strong service model for ExxonMobil participants, and really understanding their benefits packages to really be able to get you in the right situation. So when that time comes, you know exactly what your plan is, and you know who you're partnering with. Kathy, when does this video become available to view? Shaish, about a week from now, a couple days from now. I got a thumbs up from him. Shaish gave us a thumbs up, Kathy. So it'll be about a week from now, bogartwealth.com. We have a video section. We also have other content like this on our website right now, bogartwealth.com. We have a lot of these video series that's there. We also have our podcast series that's done by our CEO, James Bogart, and a list of our qualified team members as well. So highly encourage you to check us out there to get more content how it relates to the investments and pension plan. If you are searching for an advisor, gold standard is the Certified Financial Planner, CFP, knows your retirement plan, and open to different strategies and such. I think we're kind of wrapping up here. 3 offices. Again, I said most of my clients are nationwide. We meet with the majority of our clients on Zoom, as Exxon has multiple locations throughout the country. But our headquarters are up here in McLean. We have a large presence down in Houston in the Woodlands. I will be down there in the Woodlands in May. So always look forward to getting down there and meet with clients. Guys, awesome. I'm going to stay on here for a few minutes. Really appreciate your time to sit and, hear me out when it comes to the interest rates and discount rates. There's a lot that goes into it. We're just sort of scratching the surface. The bigger questions of all this, how it relates to your financial plan. That's where I know we're going to be able to help out. That's where we succeed. So really happy to be able to provide this information to you. So thanks, guys.